IT services market has diverged. Most firms prioritize pilot programs, but a small group now delivers AI at industrial scale and discloses the revenue. Tata Consultancy Services recently forced the market to pay attention to this shift. In the fourth quarter of 2026, their annualized AI revenue crossed $2.3 billion. They have completed over 5,500 AI projects across 200 client organizations. This data reveals a contradiction. While TCS reached a 4-year high in operating margins at 25% and posted record AI revenue, they simultaneously reduced their headcount by over 12,000 employees. Most of these reductions targeted mid to senior level managers. This staff reduction impacts the core of the traditional Indian IT business model. For decades, these firms relied on scaling human capital, billing hours for routine coding, testing, and support. Generative AI is now automating those functions. The simultaneous rise in revenue and drop in headcount raises a specific question for investors. Is TCS engineering a profitable transition, or is AI beginning to erode their historical manpower advantage? The bull case centers on institutional scale, a $40.7 billion total contract value, a pristine balance sheet, and a $2.3 billion AI run rate. The bear case centers on the macroeconomic environment. Traditional IT revenue growth is slowing. As global clients consolidate their vendors, TCS faces the risk of margin compression and exposure to a potential U.S. economic recession. To evaluate these risks, we will dissect the underlying business. We'll break down their revenue engines, examine their AI architecture, benchmark them against peers, and run a forensic accounting check on their cash flow. Our ultimate goal is to determine if TCS remains the primary, secure dividend compounding engine of the entire Indian IT sector. This tree map shows revenue distribution. Banking and financial services is the dominant engine at 31.9%, followed by consumer business and life sciences. Meanwhile, the manufacturing segment, roughly 9% of revenue, saw AI adoption jump 109% year over year. Factory automation provides immediate savings. Across these sectors, the delivery model is shifting towards consulting. TCS is moving away from traditional time and materials contracts, where clients pay for raw hours, towards high-value transformation projects. This pivot relies on existing scale. TCS has a workforce of 600,000 employees and holds enterprise relationships that span 50 years. They already manage the systems where the client's data resides. While new AI startups can build coding tools, they cannot instantly replicate a global delivery framework. The Tata brand provides a specific level of institutional trust required for Fortune 500 AI rollouts. Entrenched enterprise trust and execution capability form the actual moat. When global banks deploy AI across dozens of jurisdictions, TCS is the default choice. Enterprise clients currently face a specific technical hurdle. They want the efficiency of large language models, but they cannot risk exposing proprietary data to public networks or becoming locked into a single AI vendor. Wisdom Next acts as a centralized orchestration layer. It sits between a company's internal data and various external AI models, allowing seamless switching. It enforces mandatory corporate governance and data privacy guardrails, ensuring AI operates securely. We must recognize the impact of this technology. Generative AI tools are reducing the need for junior developer headcount. The billable hours for routine software testing and basic code generation are declining. Demand for Agentic AI is emerging as the replacement. These are autonomous systems that execute multi-step workflows, like invoice processing or supply chain management, without human intervention. TCS is migrating clients to these automated workflows. By orchestrating these complex systems, TCS is replacing low-margin manpower billing with higher-margin AI governance and orchestration contracts. To determine if TCS is outperforming the market, we look at the AI Services Readiness Index. This index ranks firms based on capability depth, go-to-market aggression, and disclosed revenue. A vertical tier chart shows TCS and Infosys leading the Indian IT sector with scores of 36 out of 40. This hierarchy is confirmed financially, with TCS maintaining a 25% operating margin, pushing past competitors operating in the high teens. This margin superiority allows for consistent capital returns. TCS maintains a 2.88% dividend yield, executes regular share buybacks, and trains vast numbers of employees. In a decelerating global IT market, TCS provides the highest quality of earnings. Their execution metrics suggest they are navigating the AI transition more effectively than their peer group. Operational strength is visible on the balance sheet. TCS generates a return on capital employed of 63% and a return on equity of 51.8%. These are exceptionally high figures for a company of this scale. Stated profit can occasionally be misleading. To verify a company's health, we use forensic accounting to track actual cash flow. This is a stricter test than looking at the stated profit after tax. This chart plots cash flow from operations against profit after tax. If a company inflates earnings, profit rises while cash flow flatlines. Here, the lines track tightly together, confirming that TCS's stated earnings are backed by real cash. Standard hygiene metrics support this. Receivable days are stable, and there are no adverse remarks from auditors. Related party transactions remain routine and well documented. The forensic sweep reveals zero red flags. The balance sheet is in excellent condition. This financial stability provides a significant cushion against market volatility. It allows TCS to function as a consistent dividend compounding engine. Financial stability does not eliminate all risks. The business is exposed to a U.S. economic recession. Additionally, if the timeline for AI transformation slows, the short-term revenue pipeline could face pressure. There is also the risk of margin compression. As global clients tighten their budgets, service providers must compete more aggressively for fewer contracts. This scatterplot helps evaluate the current valuation. TCS is trading at a price-to-earnings ratio of 15.4. This is slightly below its long-term historical average, but still represents a premium over its mid-tier peers. The 15.4 times PE ratio suggests the market views TCS as a mature, defensive compounder. Expectations for significant top-line growth have been replaced by a focus on stable earnings and consistent capital returns. Because top-line growth is now moderate, the entry price is critical for investors. A significant premium on the stock leaves a smaller margin of safety if global IT spending contracts. Growth drivers for the next decade are already emerging. The migration of legacy systems to enterprise data platforms and the deployment of Agentic AI will likely sustain a deep pipeline of high-margin work. Based on our analysis, TCS earns high marks across every pillar. The business model, Moat, and financial strength all score at or near 10, leading to a final rating of 5 stars. TCS is a resilient business with strong corporate governance. They recognize the threat of generative AI early and are successfully monetizing it by moving into more complex orchestration work. Success in the next decade depends on orchestrating safe AI adoption for enterprises. Large-scale code generation is becoming a commodity. Orchestration and governance are the new centers of value. Do you think TCS will maintain its leadership in this new environment? Let us know your thesis in the comments.